Hello everyone, welcome to another QuantInsti webinar, and this is your host Kshitij Maurya. And today we have a session on introduction to price action trading, and we will be joined by Varun Kumar Pothula, who is a quantitative analyst at QuantInsti. Uh, Hi Varun, are you here with us? How are you doing today?
Yes, Vijay. Hi. Hi, Vijay. Good evening. I'm good. How are you?
Yes, I can see you. All right, wonderful. So, before we start, a very quick introduction to Varun. So, Varun holds a master's degree in financial engineering, and he has an experience working as a trader, a global macro analyst, and also an algo trading strategist. And currently working in the content and research team at QuantInsti as a quantitative analyst. His contributions help in creating and offering for learners in the domain of algo trading and quantitative trading. All right, so Varun, I'm going to make you the presenter so that you'll be able to share your screen and start off with the presentation.
Thanks for the introduction. So, hope my screen is visible.
Uh, no, now yes, we can see your screen. All right, so I'm going to turn off my camera and then all the best, Varun, and I hope our audience will enjoy this session thoroughly. Thank you so much. And yeah, and one more thing, sorry guys. um, Before we start with today's session, please note that I'll be sharing links for some of the learning materials within the chat during the presentation. So don't forget to check them out, and we will also be answering all your questions at the end, as always. And so please make sure that you are putting all your questions in the questions panel. Yeah, that's about it. Over to you, Varun.
Thank you so much. So, hi everyone. So, welcome to this session on introduction to price action trading. So, in this session, we are going to discuss the basics of price action trading, like what is price action trading and what is the fundamental philosophy behind it. And we're also going to discuss several tools that's going to help you to conduct price action trading. And especially we're going to discuss about chart patterns, like how chart patterns are formed and what are all the major types. And we'll also end the session with a discussion on pivot points and strategies related to that. Before we move forward, I just want to understand your trading experience. So for that, I'm going to launch a poll. So please take 30 seconds and try to answer this. So I see 75% people voted. So let's wait for 10 more seconds and continue. Okay. So as per the poll results, almost 50% of the attendees are manual traders with experience in price action trading. So only 5% has algorithmic trading experience with price action. So rest of the people has no idea about price action trading and very beginners when it comes to trading. So let's move forward. Let's start with understanding what price action trading is. So by definition, price action trading is a process to study the fundamental price behavior across time in order to take trading decisions. So for example, you might have heard about technical analysis, especially technical indicators, where you tend to conduct some statistical studies on price, volume, and other aspects of a particular asset. But when it comes to price action trading, we just stick to price behavior. And especially, there are no technical indicators involved. There is no RSI, there is no MACD involved. So it's pure price behavior analysis. And as we can see, it's very popular among traders. Even in our poll, 50% people are manual traders with price action trading experience. So it's quite popular among traders because of its simplicity and also the success rate of price action trading strategies. And it's especially used for intraday trading and swing trading. So it is compatible for a short-term trading or medium-term trading, but it is not compatible for investing or pretty long-term trading. And so to understand this, let's take this example. So consider this asset. So I'll explain this price behavior. So it started at 90. So it dropped to 80, and again it went up till 120. Again dropped to the same price around 80, 81, and again went up to similar price level 119, and now it's back to 80. So currently, assume today it is at 82. So in this case, what would you do? Like, would you buy this stock or would you sell this stock? So I'm going to launch a poll related to this, so you guys can answer that poll. Let's wait for 10 more seconds and close it. So 85% people selected the option buy and 15% selected sell. So let's understand what's happening here. So as you can see, let's try to read the price behavior. So when it is falling from 90 to 80, and after it reached 80, it started to go up, but it was limited to 120, and again it reached to the similar level, which is 81, and again went to similar level, which is 119. So here we can observe that whenever the price come to 80, it's starting to go up, and it is not going above 120. So again it came to 80, so high chances that the price can repeat the same price behavior. So we can bet on it, so we can take a position accordingly. So probably we can take a buy position and keep a stop loss below 80. So this is how you understand the price behavior with a simplistic analysis of how the price acted in the most recent past. So yeah, so better option is to buy the stock instead of selling it. So this is just a fundamental idea behind price action trading, but it's not that simple. So there are several tools that's going to improve your price action trading analysis and also will help you to take better trading positions. So let's understand what are all the tools of price action trading. So majorly supply and demand analysis, support and resistance, chart patterns, pivot points. So these are all the main tools of price action trading. So let's understand one by one. And let's start with supply and demand analysis. So for example, consider a stock, it want to go from $100 to $200. So in general, you might have already noticed it wouldn't straight away go from $100 to $200. Instead, it goes through several price levels, and over the journey, it might go up, go down. For example, here it went from $100 to $125, but then it again retraced back to 115, and now it went to 150, retraced back to 120. So it kind of follows a zigzag pattern, and then it reaches $200. So this is typically how a stock moves, but it would never directly go from 100 to 200 straight away. So this behavior is explained by supply and demand forces. So basically this is happening because of imbalance in supply and demand forces. So by understanding how the supply is and how the demand is for a particular stock at a particular price level, we can get a clear idea of price behavior, and we can also predict how the price could move in the near future. So let's start with understanding what supply is and demand is. So what is a supply? So almost 50-60% of the attendees are traders, and you must have already seen supply is a scenario explained by the sell orders. So supply means there is lots of availability of that particular stock. So when how would an availability is created for a stock? It's created by placing sell orders. So in the market, if you see lots of sell orders, so that's the supply you're seeing. For example, in case of increased supply scenarios, you see more sell orders than buy orders. So let's say stock is at 100, so you might see more sell orders at 100 than buy orders. So that is a scenario where you see supply is increased. This is technically called as dominant. Sellers are dominant because if the selling is dominant, you see more sell orders than the buy orders. So because of this, there would be decline in prices. So if you want to understand how the imbalance of supply and demand is, you need to study the buy orders and sell orders. So due to this imbalance, the sell orders are more, then it's termed as the supply is more, and it would eventually make the stock to fall from the price. Similarly, when it comes to demand, demand is represented by the buy orders in the market, and demand is more when the buy orders are more than sell orders at any price level. So in this scenario, buyers are dominant, and you see lots of buying happening in the market, and it would make the prices to increase. So this is the basic idea of what supply and demand is. Now let's understand how this supply and demand imbalance will move a stock. So let's take a real example. So consider this candlestick chart of stock. So as you can see, the range is between 235 and 265. So the price is just moving between 265 to 235. And whenever it reaches to this zone, prices are just falling back. And whenever the prices reaches this green area, so the prices are going. So how can we understand this from the point of view of supply and demand? So this is a zone where there are more sellers than buyers. For that reason, this can be termed as a supply zone, and because of availability of more sellers and more supply than the demand, so the prices are falling from this particular zone. Similarly, if you observe this area, so the buyers are more than sellers. For that reason, whenever the price comes to this area, lots of buying is happening, and because of that, the stock is just going up. So this is called as a demand zone. So at a most basic level, this is called a supply zone and a demand zone. So how can we take advantage of it? I mean, how can you trade according to supply and demand zones? So, for example, consider this chart. So from this point, it declined to 235 zone and started to go up. So we can just start marking this zone and kind of assume that maybe buying is happening at this zone. So betting on that behavior, you can start taking buy position. And as we assumed, it started to go up. And as soon as it reached this area where the selling was observed in this recent price behavior, you can close this position. So basically, you're buying at a demand zone, selling at a supply zone, and you can trade the other way as well. So you can also open a short position once it reaches a supply zone, and once it retraces back to the demand zone, you can close that position. So basically, you can trade both ways. So typically, this is how a trade is taken when it comes to supply and demand. And you might have heard about support and resistance. Again, the philosophy is same. So consider this example where you can see the prices are going up, but once it reaches this particular price level, the price started to retrace back. So earlier we discussed about a zone where it's not a single price level, it's a zone of price levels, but it's very common to see in the market where the stock or a particular asset retraces back from an exact price level. So with a difference of like 0.5%. So this can be termed as a resistance. So generally what happens here is just like the supply zone. So there are more sellers at this zone, or there are no buyers at all at this zone, because probably people might be thinking like this price level is not eligible, like the stock is not eligible to trade at this price level, and buying will dry up, and that's where the sellers comes in and take advantage of it. Or there may be profit booking also. Whoever already bought the positions or holding the stock here can close their positions once it reaches this point, which make the stock to fall. So this is how you can understand the price behavior, and this is how you can mark a resistance. So similarly, support as well. So this is similar to demand zone, where the price is falling but unable to go beyond certain price, and from there it is going up. So you can observe whenever the price is falling, the sellers are in control, but once the decline stop, so this is where the buyers regain the control and make the stock start taking the stock go. So there may be two reasons for this. First reason is whoever had already shorted the stock, they can close their positions here. For that reason, the stock is not falling anymore and it's going up, or it could be because of fresh buying. So because of these two reasons, a support can form. So this is how at a basic level, you can use a support resistance analysis or supply demand analysis to understand what is happening in the stock and just to have a sense of price behavior. So how can you use the support and resistance? So you can create trading strategies with support and resistance, or you can also, for example, you already have a long position and you can close your long position once it reaches a particular resistance. So you can also use this as your entry or exit rates. So for example, you want to buy the stock. So you already observed that it went till this level and went up, and you observe the same behavior here. So you can mark this as support and you can start taking a position with the stop loss below the support. So let's continue. Let's understand the next two, which are chart patterns. So till now we have understood how a basic support and supply zone and demand zone are formed. And at the supply zone, you can see the price basically changes its direction, and same thing happens at demand zone also. But in many cases, when this big reversal of prices or change of direction happens, so the charts tend to create some patterns which are repetitive and quite easily identifiable. So there are basically two types of chart patterns. So as you can see, I have marked some chart patterns here which formed around the supply zone and demand zone. So in general, there are two types of chart patterns. So reversal patterns and continuation patterns. So what do you think these patterns are? Are they reversal patterns or continuation patterns? Let me just launch a poll so that you guys can answer that. Let's wait for 10 more seconds to close the poll. So 90% people selected it as reversal pattern. That's exactly right. So these are reversal patterns because as you can see, once these patterns are formed, the prices are reversing. So here the prices are going up, but then after forming this pattern, you can see the prices reversing and going down. Same thing happened here. The prices were going down, and once the pattern was formed, the price reversed and started to go. So this is a repetitive process, and these kind of patterns are repeatedly found in the market. So basically, there are two types of reversal patterns. So bearish reversal and bullish reversal pattern. So you might have already understood what these are for the names, but let's dig deeper. So consider this uptrend, and after this uptrend, so if a bearish reversal pattern was formed, so you see a bearishness in the market. So basically, this uptrend will turn into a bearish trend, which is a downtrend. So what does it indicate? So this indicates that this bearish pattern actually represents a supply zone. So we have already discussed that supply zone is a place where there are lots of sellers and which could induce bearishness into the market. For that reason, once a bearish reversal pattern is formed, you see a reversal of an uptrend. And this is not always true. It may not work 100% of the times, but increases the probability of reversal of an uptrend. So let's see the examples. So head and shoulder. So this is like most used bearish reversal pattern. So I think almost all of you might have heard about it. And double top is again a common bearish reversal pattern. And triple top. So these three are the most common bearish reversal patterns. And during an uptrend, if you see these patterns forming, so you can probably, if you already have a long position, you can start tightening your stop loss or start taking your profits, because there are high chances that the trend may stop or it can completely reverse. Similarly, bullish reversal pattern, like if you can consider this downtrend, after forming a bullish reversal pattern, so bullish reversal pattern happens when there are more buyers than sellers. Basically, it happens because of creation of a demand zone, and it would make the current downtrend to reverse, and you can see a start of an uptrend. So it signals a formation of a demand zone, and it increases the chances of reversal of the current downtrend. So the common examples are inverse head and shoulder pattern and double bottom and triple bottom. So these are the most basic patterns, and at the same time, these are like well-tested patterns and most commonly found also. There are many complicated patterns, but these are the most used and repeatedly formed patterns. So this is about bullish reversal pattern. And again, there are continuation patterns as well. So similarly, consider this round uptrend, and let's say there is a formation of a pattern. And generally, when would a pattern form? See, there is an uptrend, and people who already bought bought this particular asset before formation of pattern want to close their positions or start taking their profit. So because of this reason, instead of going up or continuing this uptrend, it can start to consolidate or it might trade in a range. So during that process, it creates some patterns. So for example, after consolidating for a particular amount of time, if it start to go up again, so this can be termed as a continuation pattern. And there are commonly found continuation patterns and repeated continuation patterns, which we'll see. But as theory says, so when there is a demand zone forming during the consolidation, so it can be termed as a continuation pattern. So in general, if there is a supply zone form, then there would be reversal of the trend, and that can be termed as a reversal pattern. But if there is a demand zone form, then you can consider this as a continuation pattern. So these are the commonly found continuation patterns in an uptrend. So which is bull flag. So this is the shape of a bull flag where you see an uptrend, then you see a flag-like pattern and a breakout to the upside. Again, you see a pennant pattern. So this is also most commonly found continuation pattern in an uptrend, where there would be an uptrend and there would be a sudden move and then the consolidation. So this consolidation is a place where most of the people might exit or start taking shots. For that reason, it will not go up, but it will consolidate for a particular amount of time. Then it breaks out and goes up. So this is called pennant. And ascending triangles. So triangles are also most used continuation patterns. And in an uptrend, if you have seen an ascending pattern, you can wait for the breakout and again take a long position, assuming that it can continue to go. So since it's a continuation pattern, it will continue to go in the same direction. So these are the commonly found continuation patterns. Again, same theory for the downtrend also. So if you have seen a downtrend and you have observed any continuation pattern, so after the confirmation of the pattern, you can basically assume that the stock can continue to move in the same direction. So the most commonly used are similar to the patterns you have seen in uptrend. But according to theory, so if there is a formation of a supply zone during the consolidation in a downtrend, then it can actually continue to move in the same direction. So the examples are bear flag, so which is exactly opposite to the bull flag, and pennant and descending triangles. So these are kind of mirror images in terms of x-axis to the previous patterns you have seen. So, but so far you've seen several patterns, but how do we understand these patterns, or how do we study the price behavior and then understand like, okay, this pattern has formed and why is it moving in such a way? So let's take an example. Let's take an example and see how this patterns forms organically and how can we understand the price behavior. So consider this chart. So this is a stock, it's just making higher highs. So higher highs means these are called swings. So whenever here it made a high and it made a low, and now it made another high which is higher than the previous high, hence it is called higher high. So it made a series of higher highs. So this is a typical behavior of an uptrend. So whenever a stock or a particular contract is in an uptrend, it tends to form higher highs. So this is an indication of a strong trend. But the next move, let's say the next move is in this way where it failed to make a new high. Instead, it made a lower high. So far it made higher highs, indicating that it is in an uptrend. Now it broke that particular trend line, which acted as support so far, and it created a lower high. So this is a behavior of a reversal, because see, so far there was continuous buying and there was a support at this particular trend line. Now that's no more available. For that reason, it was broken and it even made a low high, which is lower than the high. So it can turn into a downtrend because of this. So this is how typically a head and shoulder pattern will form. So you must have already observed. So this actually looks like a head and shoulder. So let's just understand what the structure of head and shoulder pattern is. So to form a head and shoulder pattern, the first thing is it should be in an uptrend. So these kind of patterns can be formed across the price chart, but not all patterns that resembles this are head and shoulders unless there is an uptrend at the beginning of this. Then the most important elements are shoulders. So basically these represents or kind of looks like human anatomy, head and shoulders. And then you see a head. So head is a point between these two shoulders and basically higher than these two. So if you find a similar pattern, you can observe this as a head and shoulder. See, there is one more important element for this head and shoulder, which is called as a neckline. So neckline is a place where the shoulders are taking support. So if you want to understand the price behavior, there was an uptrend and it made high. So it made a low and then it made a higher high. So until this point, the buying pressure is still there and it is in an uptrend. But if it was so strong, it would have made another high, but it made a lower high, means it formed another shoulder and it went below the particular neckline. So this is exactly the same example we have seen here, where it was following a trend line and going up with making higher highs. But at some point, it broke the support and made a lower high, indicating the weakness, and which eventually resulted to a reversal. So this is how organically a head and shoulder pattern will form, and this is how it looks as well. And it can result to a downtrend. So let's understand what happens when it forms. So it indicates a weakness in an uptrend. So let's say you have a long position in a stock which is strongly trending, but once you start making these patterns, you can basically read it as an indication of a weakness in the current uptrend, and also you can expect a possible reversal. So these kind of weaknesses can happen for two reasons, as we were discussing earlier. One thing is people are starting to take profit, means people who already have long positions are closing their long position, or there may be some short sellers in the market who are shorting the stock. For that reason, the sellers are more and the stock is not going up continuously. Now let's understand this price action again. As we were discussing earlier, whenever there is a lower high, that is a first indication of weakness in any kind of uptrend. And same thing here. So this lower high indicates weakness in an uptrend. So there is a higher high, but then here is a lower high. So there is an indication of weakness and break of the support. So in the most recent price behavior, so it took support at this price level, but now the support is no more and the prices are trading below that support. So this breakout indicates strength of sellers, and this can result into a downtrend. Now this is how you read the price behavior of a head and shoulder pattern. Now how can we read it? How can we trade it? So to trade the head and shoulder pattern, so you enter as soon as the neckline was broken. So let's say you observed that there is a head and shoulder formed, but you should wait until the price traded below this particular neckline. Only then you can take a short position. And for that, you can keep a stop loss at shoulder, basically right shoulder, above the right shoulder. You can keep 1% or 2% above the right shoulder. And where can we take the profit? And for profit, first you need to measure this. So this is called head length, basically the distance or the length of head from head to neckline. So you measure this and you can keep your profit target at this distance away from the entry. So here the length is h. So the profit target would be at a length of h or at a distance of h from the entry. So this is how you trade a head and shoulder pattern. But manually trading this head and shoulder or scanning for this head and shoulder is a very difficult task. So we can do it programmatically, and we can actually scan for maybe 20 to 30 years of data within like less than a minute using Python. So let me take you guys through the course we have on price action trading and show you how we are scanning for these patterns. So this is our Contra portal where you see a number of courses. So if you navigate to quantInsti.com courses, so you see several courses. So let's go to price action trading. So the course name is Price Action Trading Strategies with Python. So this is the landing page of the course, and let me go inside the course. So this course is a combination of videos, quiz units, interactive coding exercises, and PDF documents. So let me explain you. So this course is divided into 34 sections. As you can see, it started with an introduction, then there was a discussion on basics of price action trading. So there is a complete section on it with a combination of videos and quizzes as well to test your understanding of the video. And let's go to head and shoulder patterns. Let's go to this detecting head and shoulder pattern. Let's see how the code is able to scan for head and shoulder patterns and plot it as well. So not only head and shoulder, this course covers all reversal patterns along with its code and trading strategy, backtester, etc. And so let's see how it is done. So this is the notebook. So as you can see, this is a Jupyter notebook and it is written in Python. So this is a notebook where a code is provided to basically design an algorithm to detect the head and shoulder patterns. And in addition to that, it's going to scan for patterns. So as you can see, it will plot the patterns also for you. For example, in this notebook, we have used Apple data. We have used S&P 500 ETF, and we have used this ETF from 1993 to 2018. So by reading the file, it is able to scan for head and shoulder patterns. And as you can see, this is a function that was used to scan for head and shoulders, and there are conditions that defines this pattern. And you can see there are 18 patterns. So this algorithm scanned from 1993 to 2018 and found 18 instances of head and shoulder patterns, and it can code it as well. So this is in preview. You guys can go through the notebook and understand how it is done, but a clear understanding can be taken from the video and other units that's already there in this course. And in addition to this, so this course also provides you how to decide entry and exits for a head and shoulder pattern, just like we have discussed, where to keep the stop loss, where to keep the take profit, but programmatically. So let me show you the code as well. So this is a notebook for that. And as you can see, so our code actually found the entry point. So the price actually went below the neckline. So this is the neckline, and it took a short position, and it already decided the stop loss. As we were discussing, the stop loss would be 1 to 2% above the right shoulder, and the target would be at a distance of head length from the entry point. So that's exactly what this algorithm plotted for you. Not only that, in the same section, or in the next section, so you have code for backtesting this particular strategy. So scanning is not just enough. So in addition to the scanning, your algorithm should also backtest this particular pattern, so that you know what kind of risk parameters you can use for this particular pattern. So this is the code for backtester, and as you can see, there were several trades generated in the historical time frame. For example, let's see this trade where on October 5th, it took a short entry. Since it found a head and shoulder pattern, it took a short entry, and then it closed at October 10th at 260, which is a price target, and it made some profit. So you guys can go through this code. So it is already available in preview. So let's go back to our price action trading tools. So not just for head and shoulder, you can find similar notebooks and material for all reversal patterns like double top, triple top, etc. So next concept is pivot points. So chart patterns are mostly used while doing price action trading, and again pivot points are also most used because using pivot points you can actually exit or enter any trade. So for example, as a definition, pivot points are significant levels used to determine directional movement and also define support and resistance. So by generating pivot points, we can have a clear idea of what direction the stock is currently moving, and we can also predict the direction. At the same time, we can also note down the potential support and resistance levels. So let's see how we can generate these levels. So in general, pivot points are created using the yesterday's data. For example, I want to trade today, and I want to generate certain pivot points to understand what could be the what could be the resistance level or a support level for the particular stock. So consider this as yesterday's candle where it opened lower and it closed higher, and it is a green candle. So for this, to create a pivot, so this is the formula. So you just take the average of high, low, and close. So since we are also considering close, so it can't be a middle point. So if it is a green candle, generally the pivot level would be closer to high, and if the stock fell and if it is a red candle, it would be closer to low. But the first step of using this pivot points is to calculate the point P, which is a pivot. But it just doesn't end here. So in addition to P, like by taking this P value, you calculate supports and resistances as well. So this is the formula to calculate resistances and supports. So as you can see, R1 is the first resistance. So 2 times the P minus low, and R2 is the second resistance, which will be higher than this, which is P plus high minus low. Similarly, we have formula for support and resistance as well. So using all those, for a particular day, you can generate resistance and support levels. For example, if you are a swing trader and today you would like to take a long position. Let's say you want to take a long position, but you would like to know about what are the recent support and resistance, or what are the possible support and resistance levels. So just by using the yesterday's data, exactly open, high, low, close, you can calculate a possible levels where a long position can be taken or closed. For example, using this, if you already have a long position, you can start taking profit at R1 or R2. Or if you want to take a long position, you can wait for the stock to come till support level so that you get a better price. So this is how pivot points are calculated and used. But yeah, this is just a basic pivot point. This is called traditional pivot point. And why do we use this? So what is the difference between any technical indicator like RSI, MACD, etc. and pivot points? So the first point is pivot points are leading indicators. So most of the technical indicators are lagging indicators. They give you signal only when something is happened. But as you can see, pivot points gives you a information of resistance and support before they are formed. So hence these are called leading indicators, and for that same reason they have some predictive power. At the same time, they help you identify support and resistance levels in advance. So let's say you are an intraday trader. So generally you tend to create support and resistance according to minute by minute behavior or 5-minute behavior of the stock over the day. But using the pivot levels before the stock actually moved over the day, you can calculate them and have a proper resistance and support levels. So basically you can use this to plan your exits like stop losses, or you plan your entries, or in fact take profits also. So there are different types of pivots. So far we have seen traditional pivots. In addition to that, the goodies are most commonly used pivot points, and Camarilla and Fibonacci. So these are the most used pivot points. So let's understand one by one. So we have already seen the calculation of traditional pivots, where you just take the mean of these 3 levels, high, low, and close of previous day, to calculate pivot for today. So once you get pivot for today, you can calculate 3 resistances and 3 supports using this mean. So goodies also looks the same, but there is a bit of a change in the formula. So instead of a mean of high, low, and close, you take high plus low plus 2 times the close by 4. And a formula for R3 and S3 also would change. But the fundamental idea of pivots is the same. The way you use these pivots are the same. It's just that the way to calculate these pivots are a bit different. And again, we have Camarilla levels. So far, we have seen these traditional and goodies where there is 1 pivot point and 3 resistance and 3 supports. Basically, there are 6 resistance and support levels in total with 1 pivot point. But Camarilla levels are different. The calculation of pivot is same as traditional pivot, but there are more number of resistance levels and support levels. So theoretically, these are called H1, like H and L levels. So these are not called as resistance or support, but these are called high 1, high 2, high 3, L1, L2, L3. So this is how the formulas of Camarilla pivot looks. So as you can observe, these are like completely different. So let me just start with Fibonacci pivots again. So these are based on Fibonacci series. So Fibonacci series is a numerical series. It's a series of numbers. So this is exactly a Fibonacci series looks like. So it starts with 0, 1, and it goes till infinity. So the first 2 numbers are 0 and 1, and to get the next number, you need to add the preceding two numbers to be exact. So 0 plus 1 gives you 1, and to get the next number you add 1 plus 1 and you get 2. So the same pattern repeats. So to get the next number you add the preceding two numbers. So 1 plus 2 gives you 3, and again 2 plus 3 gives you 5. So this is how a Fibonacci series is constructed. So Fibonacci series is pretty famous because of its occurrence in nature or natural patterns. For example, you can see Fibonacci series in biology, or you can see in formation of number of petals. So in general, number of petals of a flower would either be 3 or 5 or 8 or 13, which is a part of Fibonacci sequence. And not only that, so Fibonacci series is observed in many instances in nature. And when traders started to understand the price behavior from the eyes of Fibonacci series, so for that reason, so Fibonacci pivots were calculated. So the foundation of Fibonacci pivots is Fibonacci series. To be exact, they are Fibonacci ratios. So these five are the important Fibonacci ratios. So 23.6%, 38.2%, 50%, 61.8%, and 100%. So let's see how these Fibonacci ratios are calculated, and also understand how we can take use of these Fibonacci ratios. So this is a Fibonacci series. As you can see, started from 0 to 1 and it went till infinity. So the first ratio, or the most important ratio, is 61.8. So this you can get it by dividing a number with the next number. So if you divide 21 with 34, you get 61.8. Similarly, 34 to 55 gives you 61.8, and so on. And if you divide the number with one number ahead, like if you divide 21 with 55, you get 38.1. Or as you move forward, it will convert to 38.2. So for this reason, this is termed as a Fibonacci ratio. Again, 23.6. So you divide a number with two numbers ahead. So 21 by 89 gives you 23.6. So this is how Fibonacci ratios are calculated. But let's see how we use these Fibonacci ratios. So using these Fibonacci ratios, the most famous or most used strategy is the Fibonacci trend trading strategy, where you use these ratios to enter into a trend. For example, consider this uptrend where the stock is just making higher highs and going up. If you want to take part of this trend, so in general, trader might feel like already stock moved so high. If you buy here, we never know whether it would continue to go up or it would pull back. Just like it pulled back here, which can give you losses. So for that reason, traders prefer to enter during a pullback. So for example, this is the best place to enter. Again, this is the best place to enter into the trend. So how can we calculate, or how can we find this? So we can use Fibonacci ratios for that. So the first step is to find the vertical distance from the beginning of the trend till the high of the trend. And you can divide the vertical distance using this ratio. So this is how it looks. So as you can see, the vertical distance between the high and the low is divided into several zones using the Fibonacci ratios. So using 23.6, 38.2, 50%. So these are the ratios. Okay, sorry for that again. So yes, so as we were discussing, so these particular uptrends vertical distance were divided into zones using Fibonacci ratios, and these can be taken as entry points. For example, in this example, 23.6 was used as an entry point, but in general, the most tested retracement levels are 38.2, 50%, and 61.8. So these are technically termed as retracement levels, because in an uptrend, you will wait for this particular price to retrace to this level so that you can enter into the trend not at a higher price, at a best price. So for example, if you want to participate in this trend, and if you have entered here, you have to be in a situation where you're making losses here. But had you entered here, you're much safer, because this is the point from which the retracement stopped and the stock continued to go. So for this reason, we use Fibonacci ratios to find these retracement levels. And let's see this chart. So as you can see, it is in a strong uptrend from mid-March till end of August. And after it went up, it retraced. But as you can see, it retraced almost till 38.2 level and again started to go. So if you want to take a long position in this particular uptrend, so you can actually wait till the stock retrace back to this particular zone. 38.2, 50, and 61.8, and take a long position. So let me explain you in this course how these are calculated. So basically, there are 4 separate sections for Fibonacci, where in one section, how the Fibonacci ratios are calculated will be explained in detail along with the code. And then you will be taken to real life examples of Fibonacci ratio. And then you have a Fibonacci retracement strategy, where you will be taken through the complete code of calculating a particular conditions which should be checked for a stock to basically expect a retracement, and then this notebook will calculate like the levels at which you can take a long position. So yeah, and not only that, so you guys can analyze the trades also. For example, here you can see according to the same logic where you enter at this particular retracements for an uptrend. So the strategy was backtested, and you can see here, for example, this trade was entered on March 24th at this particular price, and it was closed within a month at a much higher price. So again, this is clearly explained in a video and also in code as well in the course. And following that, there was a trade level analytics where you analyze all the trades and study the percentage of winners, losers, and profit factor, etc. And you can also like you can use the functions available in this particular notebook to draw the equity curves and understand the behavior of the performance, etc. So that's all about this. But we are at the end of this seminar. But before leaving, I just want to launch a poll. This is the last poll for you guys. So take 30 seconds and please answer this poll. So let's wait for 10 more seconds. So closing the poll, 45% selected Camarilla levels. So that's exactly right. The question is select the pivot best suited for intraday. So Camarilla levels are best suited for intraday because they are designed for intraday trading and they expire in a day. But 37% people selected Fibonacci. That's not wrong, because if you don't want to use Camarilla or if you prefer Fibonacci, yes, you can use Fibonacci levels for intraday also. But there are only few cases where you can use Fibonacci. Only when the stock is strongly trending, you can use Fibonacci. But Camarilla you can use in all conditions. And 13% of the people selected traditional pivots. Yes, traditional pivots also can be used, but most suited pivot is Camarilla pivot. And next, you can use Fibonacci pivots. So that's end of this webinar. So
all right, so I think with that I would like to thank our audience and also Varun for sharing his wonderful presentation and taking us through the concept of price action trading. For those of you who were asking a lot of questions and we were not able to address your or pick your question in this session, please make sure that at the end of the session you'll be receiving a survey. So please make sure that you are asking those questions in that survey, and we will make sure that all of your questions will be addressed by our team